Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I really enjoy getting his insights on the oil and natural gas markets, some of the best insights out there. He is Chief Investment Officer and founder at Bison Interest. His research reports on the oil and natural gas market, they are way ahead of the curve. You start seeing the research months later come out in the Wall Street Journal, oilprice.com. I think we're just seeing articles in the last couple of days about this discrepancy in demand between OPEC and the International Energy Agency. Josh was writing about it months ago from what he told me. Josh Young, thank you for joining me again.
Great. Yeah. Thanks for having me.
So Josh, you've been investing in oil and natural gas companies for your hedge fund that buys publicly traded oil and natural gas companies for over a decade. And right now we have oil prices, the West Texas Intermediate crude price at $80.67. Been kind of range bound, but trending up a little bit lately. The really big one the last couple of months, Josh, has been the natural gas price. It's absolutely cratered in the last couple of months. It's down to $1.75 when we're recording this interview on Friday, March 15th, 2024. I want to ask you, though, if you think that this low natural gas price will start to slow down oil production in the Permian Basin too.
Yeah, I love coming on this because I think you ask some of the toughest and most relevant questions. And you mentioned Bison Research has been ahead, and yeah, sometimes they've been so far ahead that we're wrong before we're right. I think you asked some of the questions that people are going to be asking, let's say in a month or two or three. So definitely lower natural gas and natural gas liquids prices are affecting Permian development. What's been happening is that post-COVID, at least on the oil side, public producers have had a lot of pressure to return excess cash flow to their shareholders. And so there's been much more of an emphasis on shareholder returns and much less of an emphasis on grow at any cost. It's been different on the natural gas side, but on the oil side, especially on the public companies, they've had that approach. And so what's happened is as natural gas and natural gas liquids prices have been lower, the profitability of these businesses has fallen substantially. And this might sound contentious because Permian producers focus on, or at least they claim to focus on their oil production, and they try to focus their investors on it. But when you look at the production mix of Permian wells, you'll notice that there's a substantial and growing percentage of that production that is natural gas and natural gas liquids. And when you look at the returns for a lot of these wells, one of the ways to conceptualize it is to, instead of just thinking, hey, every dollar spent is for an equal part for the oil stream and the gas stream and the natural gas liquid stream, one of the ways to think about it is that the dollars spent are for the oil production, and that the oil production for many, if not most, of the Permian horizontal wells that are getting drilled now and have been drilled in the last few years, that a dollar spent might get you, let's say, $1.10 or $1.20 or something back in cash flow within the first few years from these high decline shale oil wells. And the real return beyond that sort of modest return from the oil has been coming from the extra cash flow from higher natural gas prices and higher natural gas liquids prices. With the recent move down in natural gas, really since, I guess, it got pretty high up until August of 2022, when there was that issue with the Freeport LNG facility, and you went from $8 natural gas down to this recent sub $2 price, you saw a lot of that profitability, that sort of excess return, go away on these oil wells. And I think the evidence for that is you can see the trajectory, which at that time was drilling activity was rising substantially, and demand for rigs, actually, it took a few months for it to subside after that. You could see that in terms of day rates as well as active rigs in the Permian. And even though oil prices are pretty high by every standard except the price that was briefly experienced in 2022, you see a rig count that's substantially lower. So anyway, long answer to a short question, yes, natural gas prices being lower has a substantial impact on drilling activity in the Permian. And again, not every producer thinks about it in terms of oil for their money back plus a little and the profits from gas and natural gas liquids, but that is at least one way to think about it, and one way to sort of derive the returns that are generated from these bonds.
And then also you add in higher cost of capital that's competing with higher short-term US Treasury rates. So a lot of capital is not going into the oil and natural gas sector at the levels that it was when oil prices were higher 18 months ago. And mergers and acquisitions, you think that's going to slow the pace of oil production growth too? So these mergers and acquisition deals like Diamondback and some of the others, once those deals are done, the acquiring company is going to start slowing down the pace of oil production growth too?
The particular company that Diamondback bought happened to not be sort of gunning their production as much, but many of the other deals have been situations where private equity backers have been running down the inventory on their private companies aggressively, running up production aggressively to sort of unsustainably high levels relative to the size of the assets, and to very high decline rates that would make it very difficult to keep production flat, while just reinvesting cash flow from the assets and then selling at fairly high prices to mostly publicly traded companies. So that's been a trend. And what's been happening that's interesting, I think, on that front is that we're actually starting to run out of private companies for these public companies to buy. I think it's part of why valuations have been rising. And it's part of why you've seen this sort of frenzy of deal making. So the big public companies want to get more while it's still available, and the private companies sort of know that. And one of the ways to sort of juice their returns is to drill aggressively and show more production and more run rate cash flow, even though it's less sustainable, both from an inventory perspective and from a decline rate perspective. So yeah, these deals have been, they've been helpful in terms of slowing the declines, slowing the growth rate by taking out these ultra high growth private companies. But on the flip side, they've also been incentivizing this sort of, let's say, bad behavior by certain privates. And various folks have talked about this on the natural gas side. There's been more natural gas production growth by private natural gas oriented producers, but in natural gas, there's also been a lot of growth in the last few years on the public side too.
So you're saying that a lot of these mergers and acquisition deals, is it to replace tier one acreage that's already depleted? Is that really the only way that some of these larger companies like EOG and Diamondback can actually get more tier one acreage in the Permian?
No, I think it's actually sort of the opposite. I think when you look at the acquisitions, for the most part, it's been interesting. So none of this is a solicitation or investment advice or anything by me, but I've written some articles about a company that I own some stock in, that's active in the Permian. That's also bought some assets sort of on the smaller side that are sort of special situations. They actually get stuff for pretty cheap relative to where things have been, where other larger assets have transacted. And it's been interesting because when I've compared that company and their smaller valuation deals to these big ones, gotten a lot of flack. Hey, you don't understand. These big acquisitions come with lots of inventory and lots of drilling locations, and they're so great. But when you dig into the specifics of those, in many cases, you find that these large acquisitions at high valuations actually have very little inventory remaining, or they'll have inventory, but there's some issue with it, whether it's overlaying a potash mine in New Mexico, or whether it's within the city limits of a city or town in the area, or has some other issues that sort of restrict development activity. And so what I think is actually happening is these larger public companies don't really have the sanction from their shareholders to grow at the levels that maybe they would like to or would have historically. And they're also trying to sort of preserve their internal inventory, which in many cases is actually far superior to the inventory available in the companies that are being bought. And what I think they're actually doing is sort of growing through acquisition rather than growing through organic development. And there is an added benefit, which is that with many of the producers behaving like this, you're actually seeing slower production growth than you would have otherwise, because if the public companies were growing organically rather than through acquisitions, maybe you'd have less aggressive development on the private side, but you'd still maybe have more aggregate growth in the Permian than you've been seeing through this sort of publics growing through acquisition and privates growing through organic development.
We've also had a lot of natural gas rigs up until the last month or so. There was still a lot of natural gas production coming online, whether it was in the Permian Basin or I think EQT, other wells in the Marcellus, that has started to slow down a lot. A lot of these natural gas producers were hedged, I think, a couple years out worth over $3. Once those natural gas hedges start to expire, you think then that that's going to be a lot less natural gas supply, and then that's also going to mean that less of these wells are drilled, and that's going to affect oil supply too?
Um, yeah, I think it's complicated. Um, there's been a variety of reactions by natural gas producers to this lower natural gas price. And to be fair, some of it is from an exceptionally warm winter. And there is this tendency historically when there have been warm winters. I saw a stat that it was much more likely that there would be, or there were, that warm winters were coincident with um, warm summers immediately following, and so it's not totally independent in terms of it, or appears from the data that if it's warm in the winter, that the following summer may be warm. And the reason to focus on that is that a lot of natural gas demand um, over the year actually kicks in the summer for cooling in the southeast and southwest, I guess, where there's a lot of the cooling that's powered by natural gas burn, and so either directly at people's homes and offices, or indirectly through electric that's powered to a large extent by natural gas. So there may end up being some extra natural gas consumption this summer to make up for some that was foregone this winter. But there's been a variety of activities. So yeah, maybe you could say that the aggregate number of natural gas rigs is lower, but there have been some companies that have increased their drilling rig count, and there's been various reasons for them to do that. I was joking on social media that it was ahead of the election and that they were trying desperately to reelect Joe Biden, because why else would they want to drill at half of their stated required cost or required price for shareholder returns to do so? It's turned out one company, for example, was trying to buy some infrastructure, and I don't really understand the logic, but supposedly that means that they should have been drilling 3 times as much as they were a year ago, even with lower prices. Others are prepping to potentially sell, and so they've been growing pretty aggressively. And there's various others where it's still unclear why they've been as active as they have been. So, I'm not sure how to forecast behavior by companies that have been behaving irrationally, at least from a sort of outside economic perspective, how to forecast when they might start actually behaving more rationally or more directly tied to the economics of the assets that they're developing. So I think it's a tough question. I don't know that I'm expecting more Permian oil drilling activity because of the behavior of natural gas producers in either direction, really.
Yeah, it sounds like you just described a head scratcher here, that it doesn't make rational sense in a lot of different ways. I guess they could hedge the natural gas at a higher price, but some of those older hedges are going to expire, and like you said, they're going to be producing the natural gas at a loss. And some of these natural gas producers, up until the last couple of weeks, I think, were still growing production, which doesn't make sense at all if they want to continue to sell the natural gas at a loss. So it's just a head scratcher. It's bad use of capital, bad capital allocation. The market's going to penalize them for it.
I mean, you'd think, but the reality is that the history of these publicly traded oil and gas companies for most of the last 20 years has been bad capital allocation. And so, I think it's part of the reason I decided to speak out against it. It doesn't really affect the companies I'm invested in for the most part in the longer term. And, I've very little exposure to pure dry gas producers. I've preferred to own companies that may have a lot of natural gas production, but where a lot of their cash flow has been coming from oil and NGLs. Just because there is sort of more. I mean, we found out there's more rational capital allocation, but there's also more, I think, predictability. Not that the oil price is really that predictable, but it's way more predictable, I think, than the natural gas price. So I think it hasn't really been economically driven, my commentary. It's more just been, I don't like when large producers and large participants in the oil and gas markets behave irrationally, because it hurts, I think, the overall cost of capital. There was something that you had said earlier, though, that I will push back on a little. If you look at the valuations of these companies, the natural gas producers trade at wild valuations, super high relative to their run rate cash flows, even on a net of hedging basis. A number of these, they're producing, X amount, and they might only have 40% of what they're producing hedged. So, 60% or whatever might be on hedge. In some cases, they're totally unhedged. In other cases, they have a little bit more. There's significant negative capital allocation, which is a bad signal in a commodity market to investors. And despite that, the valuations are still really high. And then on the oil side, where the producers have been a lot more rational, you also see, on the smaller side, I think the small public companies are very, very cheap, and there's small deals, it looks like, on the private side that are also very cheap. But on the larger side, the valuations that some of the producers are trading at are among the highest they've been relative to the oil price in many years. So I'm not so sure that the cost of capital is so high. It might be a lower cost, or it might be a higher cost of capital for, let's say, an Exxon or a Chevron versus the average company in the stock market, but it's still a lot cheaper. Their capital is a lot cheaper than it was 3 years ago, or 5 years ago, or 7 years ago, or so on. So, it's sort of a weird phenomenon to see weak commodities, at least on the natural gas side, and then actually sort of surprisingly strong equity prices. Maybe there's more pain coming for some of these equities, or maybe they're just starting to finally catch up with the market. And if they are starting to catch up with the market, maybe there's actually upside despite some of this bad capital allocation on the natural gas side.
That's interesting, because there's a lot of good discounted cash flows for a lot of these US and Canadian, especially Canadian ones, these oil producers. Some of them are trading at 30% to 50% discounts to net asset value at low valuations, pretty high dividend yields, pretty good free cash flow. Do you think that this has to do with how Canadian oil sells at a discount, and that there's not the pipeline capacity available to get that oil discounted, unlocked, and get it to the coast at a higher price?
Not really. I think there's more. That's been a risk, but the TMX pipeline expansion is in the process of coming on. It looks like there's actually some line fill, so they're actually starting to buy some oil to put into the line to be able to allow it to start flowing. I think it's partly geopolitical risk, where there's been pipeline issues, and there's been various regulatory and other issues, and even with the pipeline issue on the oil side getting less bad, there's still significant geopolitical risk. The federal government in Canada is very hostile to oil and gas. They've implemented disproportionate rules on carbon taxing, where they exempted burning heating oils, which benefited their East Coast, the voters essentially for their current administration, but they didn't exempt burning natural gas from this carbon tax this past winter. And so it was very weird and very negative to the industry, as well as very negative to the Western oil and gas producing provinces of Alberta and Saskatchewan. So I think there is some appropriate geopolitical risk there. And again, I think similar to the US, there are companies that trade very cheap, and there are ones that are trading at their highest valuations that they've traded at either ever or in more than a decade.
So you're seeing that a lot of these things, then it's head scratching, some of them, and it doesn't make a bunch of sense then, especially with the natural gas valuations relative to the oil valuations, because aren't these oil companies, are they making a lot more free cash flow than the natural gas producers?
Yeah, I'm not sure that there are many natural gas producers that on an unhedged basis are generating any free cash flow. The ones that are either making it through their hedges or they're making it through their oil production, and they just they have some oil or NGL production, and that's enough to carry them over, or they're allowing their natural gas production to decline. And even though natural gas is below $2 an MCF right now, a lot of the producers, their actual sort of lifting cost, not counting the cost to drill the wells or acquire the land or do the various other activities to get it onto production, their actual cash cost might be a lot lower than the current natural gas price. And so the ones that are allowing their production to decline might be generating some free cash flow, but I'm not sure any of those would really count as actual free cash flow, which would be operating cash flow net of the required maintenance capital to keep production flat purely from the gas portion of their production.
So for these oil companies that I know you like to buy small cap ones with good free cash flow and lower valuations relative to the big name guys like ExxonMobil and Chevron, you think there's a lot more value there. You've talked about this in past interviews. What do you think will cause a valuation re-rating for your oil companies that are smaller ones and generate free cash flow? What do you think will cause valuation re-ratings on these companies?
So I think from a sector perspective, as oil prices rise again, and we've seen oil sort of rebound. I think it got down into the 60s a couple of times in the last couple of years. And as we're talking, WTI oil is around $81 a barrel. So we've seen a nice rebound recently. To the extent that that continues or sustains, some of the smaller companies have lower margins. And so they break even at higher prices, but that also means that they end up having more leverage to the upside from oil. So they might break even at, let's say, $50 oil instead of $40 oil, but that might mean that they have an extra 33% or so upside to cash flow from oil prices here versus companies that have break evens that are at lower prices. There's a downside to that, which is if oil prices fall more, then they are disproportionately punished, but they do have more upside. And so that actually makes the stocks of those companies even cheaper. And one of the odd things that's happened recently is that with the price of oil rising, you've seen some of the larger producers that have less cash flow leverage to oil, you've seen their share prices rise a lot more. And some of the smaller companies, actually, they haven't risen much, or in some cases, their share prices have actually fallen in the last few months, despite the price of oil and their cash flows rising substantially. So what changes that is, I think, more cash flow, and then the ability for these companies to either grow organically or grow through acquisitions or repurchase shares, or pay large dividends, or I guess in some cases pay off debt. So I think there's different paths to that for each individual company, but I think in aggregate, just sort of sustained higher commodity prices as well as additional interest in the space could help drive a re-rate. We started to see that start to fix itself in early 2022. We saw early innings, I think, of a bull market in oil for oil equities, and then we saw that fall away. And what we're seeing now is really early cycle behavior for oil, where when you see the biggest companies trade up the most, it's not so common to see that later in an oil bull market. And I think people are making a mistake here and sort of trading oil and gas as if it were like many other sectors. And the reality is that a lot of the returns, I would argue, from some of these larger producers from higher oil are already priced in, whereas none of the returns, or almost none of them, for some of these smaller producers seem to be priced in here. If anything, the market's sort of further discounting them. And that's true not just on cash flow and free cash flow, but also on reserve value and replacement cost and net asset value. And it's also true, oddly, on the services side, where some of the smaller services companies have traded down while some of the largest ones have traded up. And so this sort of divergence, I think it's promising. It shows that there are fund flows into the space, and it shows that the cash flows from these larger producers are starting to get valued by the market. And I think that's promising partly because it means that there's a next wave that's reasonably likely to come, which should lift up the values of these small companies, and them being so discounted and sort of disproportionately out of favor in the market. It's almost like the analogy of the rubber band, where you sort of pull it back. The more you pull it back, the more opportunity there is for it to snap back, and the harder it does when that happens.
Yeah, it'll be interesting to see what happens over the next couple years. There's a lot of interesting, I would say, false narratives and interesting comments from CEOs lately. We have the Occidental Petroleum CEO predicting a major oil supply problem either in late 2025 or 2026. And there's also some weird narratives out there going around that the Saudis are propping up the oil market by reducing the supply, and then also how the U.S. oil refiners can now make gasoline and diesel without oil at all. They can only use natural gas liquids and natural gas without any oil. I mean, there's just a lot of stuff going around, but the oil prices still remain relatively high. If you want to comment on some of the narratives there, if you think that, if you agree with the Occidental Petroleum CEO comments that there will be supply problems setting up in the next, I don't know, 12 to 24 months.
Sure. So yeah, I think she probably has more insight into that than almost anyone. I think there's some really interesting opportunities for the largest oil and gas companies to be able to get color on production capacity and capital plans from some of the national oil companies internationally. And Oxy has a long history of operating internationally, even though most of their activity and production and capital spend and so on is domestic currently. And so I think Vicky would probably have more insight into that than almost anyone. I think I would point out that just like everyone else, that Oxy's leadership and Chevron's leadership and so on tend to get more vocally bullish when oil prices rise, and maybe a little less so. I did this CNBC interview in January with CNBC Asia, and I talked about how I thought oil prices would rise. And I think at the time I did the interview, like, oil was down 1 or 2% overnight, and oil had just fallen from, I think it had gotten to 90 or something in October, and it had or late September, and it had fallen precipitously from there. And there were many experts that were saying that oil prices would fall a lot, and there was a lot of bearishness. And right around then, like, Mike Wirth had been on, and he talked for the CEO of Chevron. He talked about how oil prices were unpredictable and how no one knew where they would go. And I looked and saw that recently he had given an interview saying something similar to what Vicky Holub said, which is that oil prices may rise substantially here. So I'll point out the biggest difference between January and today is maybe that oil prices are $10 or $15 higher than they were then. So I think we're all sort of susceptible to that to some extent. And so I would take those comments a little bit with a grain of salt, but on the other hand, I would also try to pay attention to the reasoning around it, because again, Chevron and Oxy have more visibility into some of these plans, as well as not just on the upstream side, but also the intel they can get from the oil field services companies and infrastructure companies and so on is a lot better. So they can sort of see around the corner a little better, I think, at the senior most level than we get to. So I think it's important to remember sort of where your advantage is, and I think a lot of my advantage might be in getting to find cheap small cap oil stocks and getting to buy them before a Chevron or whatever would even consider going and buying out the company or buying their assets or whatever. But maybe a little less in terms of getting better international oil intel. So on that note, I'll point to Arjun Murti and his work on Saudi oil production. So you and I have talked about this extensively in prior interviews. We talked about OPEC Plus having much less spare capacity than the consensus view, and you can see this in the OPEC numbers. We're really the only country to have a substantial cut right now is Saudi Arabia. And what Arjun points out is that they've actually only rarely produced more than 10 million barrels a day. And so, and only very briefly. So it's been infrequent, and it's been for very short periods of time, which means that maybe they actually can't produce that much more than 10 million barrels a day for very long, which means maybe the right way to interpret their cut is as a much less significant cut than they're saying and OPEC is saying, and so on. So I think it's worth thinking about that. And we showed in our analysis at Bison, we showed that Saudi oil inventories had fallen a lot the last times that they had tried to produce as much as they produced very briefly in their oil price war with Russia during COVID, at the start of COVID, and then similarly in 2022. And also in prior periods where they had shown that sort of production. So that would indicate also that maybe it's not sustainable. So I think that sort of takes away the argument that OPEC is, that the oil market is only as strong as it is because of these deep cuts by OPEC. That being said, they do look like they're cutting a little, and that little amount probably adds a few dollars to the price of oil.
Well, there's also been a lot of inflation in the system and higher input costs. We've talked about this as well, and I've talked about this in other interviews for the last 3 to 5 years. It wasn't just the US, it was all these other countries. So you have these governments too. They have a lot of debt. I mean, the Saudis, I don't think the Saudis would be happy if oil prices went down into the 60s or low 60s. I think they would seriously think about cutting production again. I think they need a oil price at least at $80, probably 85 or 90, to balance their budget, fund their government, fund their social program. There's a lot of these national oil companies, because of inflation and the government budgets and their debt, they can't really survive or run their governments at a low oil price anymore.
That's a great point. I think that there are real budgetary pressures that sort of force the reasonable price or the reasonable minimum price for Saudi Arabia and certain other OPEC countries way higher than people want to say. And I think if they could achieve much higher oil prices through more significant cuts, they probably would. And I'm not sure exactly where in the system that would break, whether it's their expectation that Russia would export more, or that US shale producers would ramp more, or that Canada would grow more. Canada's growing a few 100,000 barrels a day this year. It's sort of funny. Everyone was so upset about these high oil price differentials in Canada for so long, and then they get pipeline capacity, and they're going to take a big chunk of that out, that excess capacity, right in the first year, on track to potentially having high differentials again at some point in the future. So, I'm not sure where exactly the Saudis are worried about that, but I think if they could have $120 oil right now, I think they would. And the reason that matters is when you look at those budgets, like you mentioned, and you look at the impact of inflation, you start to realize that the Saudis may actually not ramp their production if oil prices rise materially from here. If anything, especially with the way the US and Canadian and other leadership have treated the Saudis in the last few years, they might be inclined to facilitate different different leadership in the US through higher oil prices in this election season, sort of similar to the possibility on the natural gas side. And again, I don't know for sure, and I don't want to attribute motivations that may not be there, but there's certainly an incentive. There's certainly an incentive to not bring on more production and to have much higher oil prices, just to fund their budgets. And then I think one more thing on the inflation point. Oil companies have experienced inflation too, both in terms of their direct costs being a lot higher than they were 5 or 10 years ago, as well as there being less oil available to produce for cheap. And so I think getting back to that question on these sort of various theories, it seems like every 6 months or so, there's a new sort of very popular bearish theory on oil. And I think it's actually a very positive thing from a sentiment perspective, where when you stop seeing these extremely popular narratives coming up that are negative on oil, maybe it's time actually to sell oil and gas stocks. But there was this narrative around the start of the year on OPEC getting ready to flood the market, and clearly that's not happening. If anything, I think for a lot of reasons they want to not flood the market. They might like less oil coming on than currently, and even much higher prices than today. But then you saw, and then obviously that didn't happen. But it was very popular, and it sort of went all over social media and on TV and in the news and so on. And then there was this sort of more recent thesis on peak cheap oil, which you were alluding to, which cited blending of NGLs into in the refining process to get into gasoline and so on, which certainly happens, but isn't new. And if anything, the NGL glut that we've experienced outside of ethane, which is just a disaster. I mean, it's wonderful for the U.S. It's helping fuel the U.S. manufacturing boom and petrochemical boom. But outside of ethane, natural gas liquids are actually the market is tightening quite a bit, and prices are actually starting to rise. So ironically, they were inflecting up right around when that sort of peak cheap oil is a myth theory was getting popularized. And again, it's almost sort of remarkable when you look at it and think about how quickly one of these things spreads and how popular they get. And then you go from where that was getting where that started and was getting pushed, and what the advocates of it were saying it would mean for oil prices in the near term, and how it meant oil would go to 50 and stay there for a while, and how this meant that peak cheap oil couldn't be happening when you see oil prices actually rising instead of falling, and some of the factors that were cited have actually not been true, in some cases almost at all. And so getting back to the oil companies, when you look at their financials and you look at sort of what their actual costs are, they've risen not just because of inflation, but also because there's high decline rates on shale fields. And once you've experienced the bulk of that initial decline in shale wells, their operating costs end up actually being pretty high. And so the average operating cost for oil wells is increasing, and the average decline rate worldwide is increasing. And so you can look at the financials, but also just look at the basics of the business. And the basics of the business show you and tell you that the minimum price essentially for oil is rising in terms of the break even on an operational level. And with a rising break even and rising finding and development costs, you're seeing the sort of floor for oil rise pretty materially. So it's just a very odd, disconnected perspective. But again, similar to the OPEC wants to flood the market or is going to flood the market near term or whatever. I don't know. I mean, like, how do you fight something like that? And so my take was just to not say too much and just try to find great opportunities to deploy capital and buy some more cheap small cap oil stocks that sold off a little more on that narrative.
Yeah, I think there's a lot of false narratives, and the narratives are OPEC has a lot of spare capacity. And as you pointed out, I don't think they have a lot of spare capacity. Now, the Saudis do maybe have some spare capacity, but the rest of OPEC, and you've been putting this out in your research reports for years, they're missing their quotas by a lot. So I don't know. They just keep repeating these false narratives. It's politicians, bureaucrats, ESG. The government is really bad with energy policy and capital allocation. What they've been putting out false narratives that they're going to phase out fossil fuels, and then coal demand hits a record high in 2023 globally. They put out that they're going to phase out internal combustion engines, some politicians and bureaucrats, by 2030. And then they subsidize all these electric vehicles. But other than Tesla Motors, Josh, it looks like a lot of these electric vehicle companies, we've already had some bankruptcies in the last couple of months. It looks like there's going to be a lot more. Maybe only Tesla Motors survives all this.
I don't know. I guess I should disclose I own a small number of far out of the money put options on Tesla. So I try to have some a basket of essentially market insurance in case of a stock market crash or some other sort of panic. And especially as we get into the 16th year or something of the market rising almost every year since the financial crisis, just the odds of a crash from a historic perspective rise. So I like to have some insurance. And so I don't know if I'd be so sad if Tesla went bankrupt purely from a financial perspective, where it would put those puts well into the money. But yeah, it does seem like the as Tesla advocates would say, the legacy automakers have done very poorly with electric cars financially. But Tesla, I think, has also had significant issues, and they just had, I think, their plant in Germany has been offline now for a few weeks. And they've had different excuses for it, but the reality is that their backlog is rising. Their discounts rose substantially. One of my friends owns a Tesla, and he was buying another one, and he told me that there were the most deals and subsidies and whatever ever for a Tesla, that were offered by Tesla to encourage him to upgrade. So that's probably not so promising for them. And it is noteworthy that that's happening at the same time as the legacy automakers are having trouble selling their electric cars. So it's not just them struggling, it's also Tesla. And so if that trend continues, which it may not, right? Like, electric car adoption has been pretty rapid. But if this trend continues, then maybe the electric vehicle market becomes less of a growth market, in which case very aggressively geared companies like Tesla may actually have some significant trouble.
Well, there was still the bankruptcy from the United Kingdom electric vehicle manufacturer, and the shares of the other electric vehicle companies, I think Rivian and some of the others, the one that's partially Saudi owned, and those ones are not doing well. So, but I would argue, though, I think the main point I was trying to make is that the government, so politicians, bureaucrats, Congress here in the United States, their capital allocation for energy, whether it's wind, solar, biofuels, electric vehicles, it's been really, really bad. I mean, a lot of these companies have either gone bankrupt or they need bailouts. And instead, you have the real world problems, as you highlighted. I think there's a lack of CapEx investment into good oil projects. And a lot of the capital allocation instead is still going into ESG, especially if the government's allocating the capital, and we're not getting good return on investment as taxpayers.
Yeah, I agree. And then there's some crazy stuff going on. So I saw, it was in the news today, that apparently the U.S. Import-Export Bank, I could be getting the name slightly wrong, but it was something like that, just funded a $500 million oil development project in Bahrain. And so that's remarkable because the current presidential administration here in the U.S. is trying to get banks and insurance companies not to insure, not to lend to oil and gas companies domestically, and they're withholding permits and causing all kinds of issues for domestic producers. And then through an arm of the federal government, they're lending money for foreign development of oil. And they claim that it's going to lead to more alternative energy development somehow, but the logic of that escapes me. And
there is no
pretty,
logic.
pretty remarkable. There's not, and there is a lot of malinvestment, right? So on the alternative energy side, you look at a lot of these companies that are going to zero, and then some of the companies that aren't, but where they're building things that only exist because they're subsidized in competitive markets, where as soon as they're not subsidized, then maybe they'll go to zero. It's just unfortunate. I think every generation, it seems like, has to be reminded that central economic control fails, and that private markets are way better with these things. And when you try to intervene in the way that the U.S. government's doing, and that other governments around the world are doing right now, you end up with just increasing losses. And it does look like we're in this next bout of inflation, and that's not an accident. And it does seem like there may be a lot more to come, to the extent that governments keep doubling and tripling down on these sorts of policies, while at the same time encouraging foreign governments and foreign companies to do some of the same stuff that they won't allow domestically.
Well, we also see this with the liquefied natural gas import facilities for a lot of these countries. A lot of those countries have drilling bans. So it's so hypocritical. But a lot of the energy policy, and I would argue the energy policy out of all the different agencies for the federal government and other countries too, like Germany, it's the absolute worst, but we need it the most. We need cheap to run the economy. We need cheap energy. We need electricity. We have more electronics devices. We need all these things. And yet the capital allocation for what wind, solar, biofuels, electric vehicles, it's just absolutely terrible. I mean, they should have been, I've been saying this for years, they should have invested in nuclear power 15, 20, 30 years ago so we'd have cheap electricity now. Instead, they're just starting to think about it in the last 6 months. But the capital allocation for the last 10 or 15 years, they've just wasted probably trillions of dollars on bad energy investments by the government.
I agree with all of that, except as I see wheels of planes fall out of the sky, my appetite for government sanctioned nuclear power plant development is waning a little bit. And I have to say, I think, it's really concerning. And again, I think there are lots of great engineers working on all of these different things, from planes to nuclear plants to natural gas to so on. But I think like the one that has by far the biggest left tail risk is on the nuclear power plant side. And again, people get so mad when you talk about this stuff because they say, oh, it hasn't happened yet. But just because something hasn't happened yet, if you can identify a real risk, which is that engineers and project managers and so on are selected for criteria other than their competence in engaging in that activity, the thing that has sort of this biggest left tail risk are nuclear power plants and nuclear weapons. And it's really, really scary to think about. So I'm personally quite worried. I think until we sort of resolve this issue and get back to societies where we value and engage in labor that's rewarded for competence and not for other non-competence related criteria, I actually don't know that I really want too much nuclear power plant construction or nuclear weapon construction.
Well, there's actually, I don't know if you looked at any of the research. This is a little off topic, but there's free market innovation for small modular reactors that are a lot cheaper, and they would actually not produce anything close that could be used for nuclear weapons. So, I mean, like that has been blocked by governments for the most part for a couple decades now. So that's like the future. That's next generation are these small modular reactors that are going to be cheaper, smaller, and none of the fuel rods can be used for nuclear weapons. So I don't know how soon those are going to be implemented, but I know they are going to start building pilot plants soon.
Yeah, I'm a huge advocate for that. Anything that reduces the left tail risk on this stuff, I'm in favor of. And again, I think when you think about building these large new nuclear power plants, if it's the same people that are, and obviously it's not the exact same people, but if it's the same sort of management style and culture and criteria associated with the folks that are building our weapons and planes at Boeing, I think we have to think really carefully about using past accident statistics to forecast future accident statistics. Again, I'm very in favor of nuclear energy. It's clearly very safe and clean, but I think it also is very important to be humble about where we're at from a societal perspective and to acknowledge the significant left tail risk. So yeah, SMRs seem like a way better solution, partly because it sort of removes a lot of that left tail risk.
And let me add, since I know a lot about the military industrial complex companies like Boeing and Northrop Grumman and Raytheon here in the DC metro area, they employ so many people around here. Boeing's not a free market company. I mean, they were getting bailouts in the 60s and 70s. They've been getting bailouts all along the way. There's tons of waste, fraud, corruption, and abuse. The Pentagon budget is not efficient at all. So they got bailed out in the 60s and 70s. Jim Rogers, the famous hedge fund manager, I mean, he was buying those shares for pennies out of bankruptcy, and they got bailouts. And I think he made 10,000% returns at Quantum Fund on his bailout trade. Him and George Soros did. That was like his biggest trade.
That's amazing. I actually didn't know that. Learn something new every day. That's
Yeah.
But to be fair, I'd argue that the companies involved on the large scale nuclear power plants and projects, also these large regulated utilities and some of the largest construction firms and so on, I think it's sort of they're swimming in the same pool. So I just think it makes sense to be cautious and just be very aware of where we're at from a societal perspective. And I think like the risk on drilling an oil well or continuing to operate an existing coal power plant and coal mine, or on many of the other different potential power sources, I think there's just less of that sort of extreme left tail risk. And again, it's a cleaner, better, safer solution, except for this thing. And it hasn't been that bad. We've been very, very fortunate in terms of what's happened from meltdowns and so on. But I think it makes sense to at least consider it.
Yeah, I agree. And people who are investing in energy, a diversified approach. So just because uranium has been going up a lot the last 12 months and it looks like it's in a bull market does not mean you should not be diversified. I mean, a smart energy investor, I think, should be contrarian here, looking at some of the values that Josh has been talking about with some of these small cap companies. There's free cash flow there. There's dividends, dividend yields here, sizable ones, I think above 4%. And there's very, very cheap valuations. Over time, you will outperform markets here by buying low and selling high. And this is why we're starting to see some of the smarter, more astute hedge fund managers and contrarian value investors, whether it's Stanley Druckenmiller, taking profits in NVIDIA and these artificial intelligence stocks. He was in those a couple of years ago. He's taking profits now, according to 13F filings. And the only shares I think Warren Buffett is buying lately, I think, are Occidental Petroleum, although he's too big. He can't buy your companies, Josh.
Yeah, and Buffett does talk about that, where he says that if he were running a lot less money, he would be doing a lot better. And just before I get lynched by the uranium crowd, I do actually have a small amount of right tail exposure to the uranium trade as well through a couple of different vehicles. And so I do actually have long exposure to it. I just think it makes sense to talk about the risks too, from a sort of just acknowledging what's happening in the societal moment.
Yeah, I agree. But I think a lot of people, though, they're going to chase what's going up. So they're not going to be diversified. They're not going to be contrarian. So, I mean, the goal over long cycles is to buy low and sell high. Most people don't want to do that because it's mentally uncomfortable in a bear market or if the markets are going sideways. But if you're going to be diversified for energy investments, I mean, you have to have exposure to oil and uranium. And even though uranium has been looks like a bull market for the last 12 months, I mean, the contrarian approach, the valuations are way, way cheaper for these free cash flow companies on the oil side right now, I would say.
Oh yeah. I think on a company value perspective, relative to current prices, I don't think there's much competition with some of these small oil and gas producers. It's pretty remarkable. I would say it's not quite at the point where Jim Rogers was buying Boeing, but I think there's room for some of these things to 10x or more over this cycle. And I think some of the stuff that's worked, that has good price momentum, that has a lot of fans and a lot of people tweeting about stuff and emailing about it and writing it up. I think a lot of that stuff has mostly played out, and there's a lot of room on the smaller side for this next set of companies to materially outperform.
So I want to thank you today for your time, Josh. My listeners want to follow you on Twitter or take a look at your Bison research articles. How do they do so?
Great. Yeah. Bisoninterest.com. People are welcome to sign up for our free, roughly monthly newsletter. And then you can find me, just search for me on Twitter or find Bison at Bison Interests.